gold wants to go higher. There's a lot of people who don't have enough of it. They'd like to buy at lower prices. They're waiting for that lower price. And every time we get a couple of percent off, if you're lucky, you get your order in when it's a couple of percent off. But the reason it's going higher at the moment, I think, is just a general uneasiness about holding large cash balances. And that's not just in dollars. It's euros, pounds, yens, whatever you like. Maybe not Swiss francs so much. But those who've got large cash balances feel that they're not sure what tomorrow holds. There's a feeling we moved into a more unstable world where the pronouncement from some president somewhere can suddenly change the landscape for your currency. And, and people are saying, well, we've got in Europe, we've got political crisis in France. UK, it's sort of edging on the edge of a political crisis. USA, there's a huge political crisis. People say, well, what's coming tomorrow? And the feeling is they've got to do something with their money, which isn't cash, because they just don't know what's going to happen down the line.
According to Clive Thompson, fear is what is driving the present gold boom rather than speculation or excitement. Amidst the market commotion and headlines, affluent investors and institutions are discreetly withdrawing their funds. People are losing faith in fiat money. Every major currency, including the dollar, euro, yen, and pound, feels susceptible to fiscal disarray, central bank errors, and political unrest these days. A central banker's thoughtless comment or an unanticipated policy change can rock global markets. This gold rally is being driven by that growing sense of anxiety. It's self-preservation, not greed. Individuals don't believe that their money will purchase the same goods tomorrow as it does now. Although Thompson acknowledges that gold might be a bit overbought right now and that a retreat wouldn't be astonishing, he maintains that this is only a temporary pause before a much larger advance. He claims that the long-term trend is still firmly bullish. Be sure to like, subscribe, and hit the notification bell for more insights into gold, silver, and precious metals investing. Share your thoughts on the market in the comments below.
Amid the government shutdown and concerns possibly of a recession and all of that, your perspective and your analysis right now, what is happening?
Well, first of all, there was something which made me quite laugh this morning, and I won't name the bank, but it's a very major US bank, came out and said gold could reach $4,000 an ounce. And I looked at the price, it was $3,977. I thought, why do they wait until it's $23 away from the $4,000 mark to tell us it's going to reach $4,000? I mean, that's kind of an easy one, but I suppose they just want to say we predicted it. Of course, you and I and many of your viewers have been saying that gold could go up to 4,000 and beyond, and we've been saying it for years. I think it's gone faster than many people expected, and the whole world, and I get many messages about from people saying this, when's the pullback coming? I'm not in, I want to get in, but is there going to be a pullback, and at what price should I put my limit? And I think the reality here is a lot of people missed the boat or feel they missed the boat. And so every time there's a pullback, they say, oh, it's happening at last, I'll get a lower price. And then that pullback starts to bounce and they say, oh, am I missing the boat? And they'd rush in and then it gets pushed to another all-time high. So I think the problem we've got, it's not really a problem, it's just a feature, that gold wants to go higher. There's a lot of people who don't have enough of it. They'd like to buy at lower prices. They're waiting for that lower price. And every time we get a couple of percent off, if you're lucky, you get your order in when it's a couple of percent off. But the reason it's going higher at the moment, I think, is just a general uneasiness about holding large cash balances. And that's not just in dollars. It's euros, pounds, yens, whatever you like. Maybe not Swiss francs so much. But those who've got large cash balances feel that they're not sure what tomorrow holds. There's a feeling we moved into a more unstable world where the pronouncement from some president somewhere can suddenly change the landscape for your currency. And and people are saying, well, we've got in Europe, we've got political crisis in France. UK, it's sort of edging on the edge of a political crisis. USA, there's a huge political crisis. People say, well, what's coming tomorrow? And the feeling is they've got to do something with their money, which isn't cash, because they just don't know what's going to happen down the line. I think we've got a little bit frothy, but that means we're kind of ripe for a little bit of a pullback. But it doesn't mean to say that the bull market is over, not from a long, long way. I think the general trend is still going to be upwards, and there's armies of investment managers out there who don't have enough gold in the portfolio. About a week and a half ago, 2 weeks ago, I attended an investment conference at which many chief investment officers were speaking, from family offices and from some major banks. And I recollect in particular, one of the major banks, it happens to be the one I bank with, was speaking. And he was saying, of course, with gold going higher, we've got it in our portfolio, we're recommending it to our clients, and we're using it in our discretionary portfolios. I thought, that's interesting, because my portfolio, discretionary, has got a 0% performance this year. I wonder if there's any gold in it. So I went to have a good look. And there wasn't an ounce of gold in my discretionary portfolio, despite the fact that the CIO is standing on the stage telling everybody that they're smart because they put gold into the portfolios. So here's the reality. I think across the board, investment managers would like to say that they're in gold, but a lot of them haven't yet done it, at least not for all their clients. It's one of those things which is work in progress, and they've got to get it done by the year end, because at the end of the year, people are going to be getting their portfolios. They're going to be looking at the portfolio and saying, did you own the asset which beat Nvidia, which is gold? And they can't not have it. So I think that's the direction of travel from the investment world. The question is, how much are they going to put in the portfolio? Will it be 1%, 2%? I did read one or two banks are saying 5% is the right number. And there was one bank, I think it was Morgan Stanley, even came out and said, now we're 60, 20, 20, with 20 in gold. Now, whether they're really putting 20 in the gold or that's just a sort of general comment, I don't know. I mean, it's not possible to put 20% in gold for every investment manager on the planet. There's enough gold out there at any price, so that won't happen. But if every investment manager could get to, say, an average of 2%, and I understand the figures are on average below 1% at the moment, that would push the gold price a long, long way. Yeah, I mean, perhaps the below 1% number, I think, is a correct number. But to put it in context, a lot of the investments out there could not be in gold because they'll be, for example, an S&P 500 fund. It cannot be in gold. It'll be a fund dedicated to small caps. Can't be in gold because gold isn't an equity. So there's a lot of funds which just can't be in gold at all. So when I say below 1%, it's an accurate figure from what I understand, but it obviously it does encompass all kinds of investment vehicles which couldn't own gold under any circumstance, not allowed to, because it's not part of their mandate. So probably the real figure, which is actually invested where it's allowed to be invested in gold, is probably more like 2.5%. So I'd say for those mandates which can invest in gold, if they can get to 5%, we've got a large rise in the price coming. It's going to happen, in my opinion. The real question which is out there is, or three questions really. One is, will it happen? And I've answered that one. I think they cannot afford not to. The second question is, when will it happen? And the third question is, at what price? Now, there's been a lot of numbers bandied around about the right price, and I postulated that it might be $15,000, which I felt was the right level to, one, cover this year's deficit, a bit of next year's deficit, and pay off the maturing bonds in the next 12 months. So they could have a year or two of grace where the government debt actually goes backwards instead of forwards, because there'll be, as bonds mature, they'll be repaying them and not having to borrow. And as far as the current deficit is concerned, based on my $15,000 level, at least for a year and a bit, they would be able to pay all the bills without running, or all the excess bills above what they're collecting taxes, without running into deficit territory. So the debt of the government would be, for a year or so, maybe a year and a half, 2 years, be going backwards. And it would give a little bit of breathing space to work out what they'll do going forwards. Because obviously the debt cannot continue increasing ad infinitum, because it can increase ad infinitum provided it doesn't increase faster than the economy. But unfortunately, it's increasing much faster than the economy. The economy is growing by 1 or 2 or 3%, and the debt is increasing by 6 or 7%. So that can't continue. It's like you have a credit card. You might get a higher salary, but if your debt on your credit card is increasing by 10% a year, but your salary is only going up by 5% a year, you're actually going backwards. And in the end, you're effectively bankrupt, because you get to a point where the interest you're paying to the credit card company exceeds everything you earn. And that's the situation and the direction of travel that the government's in. And it's not just me saying it, it's the Bureau of Labour Statistics themselves who say the same thing. So 2 or 3 years ago,
Clive Thompson believes the US government could, in theory, cover its yearly budget deficit, roll over maturing bonds, and even pay down part of its massive debt without needing to borrow more. It wouldn't solve every problem, but it could buy Washington a bit of time, maybe a year or two of breathing room, which Thompson says is desperately needed. He explains that basic math is the true problem. The United States debt is expanding 2 to 3 times more quickly than its economy. The national debt is increasing at a rate of 6 to 7% annually, whereas GDP is increasing by about 2 to 3% annually. It's comparable to someone whose credit card debt continues to rise more quickly than their income. According to Thompson, a significant portion of federal revenue is already being consumed by interest expenses, leaving less for other purposes. Confidence in US bonds will begin to decline if this keeps up. Investors will start to understand that the only ways they can get their money back are by taking on more debt or by increasing inflation. This means that even if they do get their money back, it will be worth much less than it was before. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
About 8% of government receipts went into paying the interest on the national debt. This year, it'll be 18%. So we go from 8 to 18% of the interest paying, of the tax collected going and paying debts. And the Bureau of Labor Statistics, if you read their official budget, which was brought out last January, so it's very, very old, and it's got worse since then. But when they brought out in January, they postulated that they predicted it. If you look at their own numbers and crunch them, you'll find that they're going to, in a couple of years, 22% of GDP. And that's based on an assumed interest rate that the government will be paying, which is significantly lower than the lowest rate they can get at the moment. Because the lowest rate the government can borrow at the moment is something like 4%. But the assumption is that interest rates are going to be knocking around 3% for all maturities. That's the Bureau of Labor. So they've underestimated the number, but even with that underestimated number, that debt is going to go to 22% in a couple of years of not the debt. The interest they're paying is going to go to 22% of what the government collects in taxes. Now, if you project that forward ad infinitum, you get to a point where the interest payments become a larger and larger share of the taxes being collected. The question is, at what point do investors say, I'm on a hiding to nothing. I'm not going to be repaid in anything which is worth something, because this is just spiraling out of control. If it was your best friend, you unless you wouldn't lend him money. You might give him the money because you feel nice to him, but you wouldn't believe that if he had a credit card debt of that size, that you've got any chance of ever being repaid. Now, people say, I will be repaid because the government can effectively print money ad infinitum. They can tax the population ad infinitum if they have to. They could charge people, everyone, 100% of what they earn and hopefully get it back. So people still believe that they're going to get it back from the government. But the reality is, if you do get it back, you're going to get it back in heavily devalued dollars 10 or 20 or 30 years from now. And it will not buy you the kind of things in retirement that you could buy with the same amount of money today. It's going to buy you an awful lot less. So I think it depends on where you are in life. If you're living hand to mouth, these things don't really affect you, because it comes in one end and goes out the other end. And if prices go up, your salary will probably go up with it. But if you happen to be a wealth accumulator, you're now in a battle to say, what can I do to preserve my wealth? Because otherwise I will be going backwards, especially if I've got $1 million in government bonds or Apple bonds or anything else like that. If you're measuring against foreign currencies, of course, they're all falling together. So the pound, yen, euro, Swiss, even the Swiss franc, they're all, along with the dollar, they're all going down together. So when you look at the dollar versus a foreign currency, it may seem to have lost only, let's say, against the euro, only 11% this year, which is just a normal annual movement. Sometimes it goes up or down 11%. But if you think that both the dollar and the euro have probably lost 20 or 30% against gold this year, so they both are going down, and the whole world's watching dollar-euro balance, but they're not watching euro gold or dollar gold and saying, well, hang on a minute, in real money, if I own dollars, I don't have as much real money, being the gold, as I would have had a year ago by a long shot. And it doesn't matter which currency you look at. And that's not just new today. This has been going on ever since the world went off the gold standard. So that was in 1971 as far as the USA was concerned. The rest of the world had effectively come off the gold standard before that and gone on to what was since 1944 a dollar standard. So the US dollar was on a gold standard at a fixed rate of $35 an ounce. So the whole world not Americans, but the whole world except Americans, were allowed to change their dollars into gold at $35 an ounce, or vice versa. And the US Treasury stood ready to deliver gold to any foreign nation who said, "Can we have our money back, please?" And that all went on just fine and hunky-dory until the government the US government had continued to borrow more and more and more money, with the whole world believing they could turn it back into gold. And then some nations started to realize, well, they've borrowed more than they've got in the bank in gold, so they can't pay everybody. Let's try and be first. So country after country started asking for their gold back, which started to drain the USA of their gold reserves. So it got to a point where Nixon said for these speculators, these wicked speculators speculating against our currency, we've got to put a stop to it. So we'll temporarily close the gold window so that these wicked speculators, meaning foreign central banks who happen to hold a lot of dollars, couldn't change their dollars into gold anymore.
Clive Thompson says there are 3 key questions. Will it happen? When will it happen? And at what price? His answer is clear: it has to happen. The US simply can't afford not to revalue gold. He believes around $15,000 an ounce could be the right level. At that price, the government could pay off maturing bonds and cover the deficit for a year or 2 without borrowing more. It would give the US a brief moment of relief before debt starts climbing again. According to Thompson, debt is expanding 2 to 3 times more quickly than the economy. While GDP increases by about 3% annually, debt is rising by 7%. Interest payments gradually swallow everything, much like when your credit card bill climbs faster than your salary. He notes that there isn't much left over after the government's interest expenses increased from 8% to 18% of federal revenue and may soon reach 22%. He claims that investors will eventually lose faith. They will understand that they may receive repayment, but only in depreciated dollars that will eventually be worth much less. Gold is important because it cannot be inflated or reproduced. Every major currency has been depreciating in relation to gold since the United States abandoned the gold standard in 1971. Thompson's point is straightforward. Gold is for protection, not for financial gain. The United States cannot avoid the math indefinitely, even if it continues to print and borrow. People will look to gold as an asset for true value when trust in paper money decreases. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and turn on notifications so you're always up to date. Thanks for watching.